Everybody, okay, we're live. Are you guys watching the Berkshire meeting? It's going on right now. They're taking a break, I believe, but I'll just watch it later. I just released a video on the 1031 exchange. If anybody has a question and wants to talk about it, we can talk about it here. If you use the 1031 exchange to buy real estate, you get an extra 16% return on this particular example I gave. I put together this chart, the GDP by country. Just fix. So the US is 27% of the world GDP. Such a small country. And we control 27%. China is 17%. So the top two countries are almost half. If you add Germany, then it's half. Half the world GDP is contained within the top three countries. 113 trillion. These numbers are in billions. 113 trillion world GDP. US is 31 trillion. Can you cover HIMSS or AppLovin? Yeah, definitely. I was going to do a video on cap rates. That's the return you get when you invest in a commercial real estate. But I thought what would be fun is to go through Berkshire's first quarter. I'm trying to remember where I put it. Okay, it's right here. First quarter report. And you obviously can't read every single SEC filing, but if there's one you read each year, it should be Berkshire. You learn a lot. This is not, the annual report is a lot easier to read. This isn't so easy to read, but this is generally what I do on my channel. I talk to SEC reports. So this is the first quarter of 2025. It was released today. And the first page, well, this is the 10Q. The 10K is annual. 10Q is the 3 quarters before the K. And the first page, they show all the securities that are out there. So the two you're probably familiar with is Class A and Class B. These are the common shares. So Class A, I think, is $800,000 for one share. And then in 1997, they added the B shares. So it's more affordable. So Class A is that. Class B just okay. How much is Class B? Does anybody know? It's 1/50th of Class A. Oh, sorry, 1/1500th. So if you own 1,500 shares of Class B, that's equivalent to one share of Class A. So that's how they did it. I think it was 1997. They added the B shares. And at the time, it was $21. So when it first came out, you could have paid $31,500 for one share of stock, which I mean, compared to 830,000, it's nothing. But at the time, $31,000 for one share, I'm sure it seemed like a lot. I can't believe how much it went up. It went up 2,500%. So you could have 25x your investment. And what year was this? I mean, it was a while ago, 96. 1996. Because I remember when I got into the stock market, it was in 1991 or 92. So kind of close to this, actually. I was in high school, and what I mainly did was I would just open a Wall Street Journal and look at stock prices. That was my due diligence at the time. I would just go through and look at the prices, and this would always stick out. I think it was like when I started looking at stocks, this was like $13,000 for one share, and at the time, I was like, who would pay that much money for one share? What idiot would pay $13,000 for one share? Because I'm looking at all the stocks, and it's like, and it wasn't. It was written like this. If it was $4.50, it was four. It looked like this: 4 and 1/2. There was in fractions when I started looking at stock. They changed it sometime in the late 90s. They changed it to decimals, but it was fractions when I first looked at it. I think everything was broken out into eighths. So 4 and 1/8, 4 1/4, 4 3/8, 4 1/2. Damn, I bought it in 2017, one A share. And at the time, and when I bought it in 2017, how much? Let me see how much I paid. I keep track of all this stuff. $262,000 in March 2017. So one share of stock, at the time, $262,000. Even now, it's a lot of money, right? You could depend where you live, but you can actually buy a house for that price. So it just seemed really expensive for one share of stock, but I saw the value. Now I'm sure people say the same thing. Oh, who would pay $800,000 for one share of stock? But it's a good investment because I'm up 200% on my investment. You're right here, 262,096. It was March 2017. So 8 years ago, I'm up 209%. So that's my best gainer. It was new holdings, the Brazilian fintech. I was up almost 300% on new, but that it's come down a little bit. Banks have regressed. So pretty small portfolio. 2, 4, 6, 8 investments. One of them is going to expire. I just bought puts when Bitcoin hit $100,000. I bought puts on Mister. And obviously, I'm going to lose my entire investment. It was about $3,000 of puts. And it was up at one point when Bitcoin was coming down to like $60,000, but now it's coming back up. As you know, this company levers Bitcoin. They buy convertible debt. They issue convertible debt, and the funds from the sale of that debt, they buy Bitcoin. Now, so the first page of the SEC report is what securities BRK offers. So the A and B, which we just went through, you can buy either one. Obviously, the B is a lot cheaper and more affordable. You can buy debt. They issue debt. This particular debt instrument expires in 2027. It pays 1.125 interest. 0.125 is 1/8. And then they have debt that matures in 2028 up through 2059. So why do they pay such low interest? Because there are low credit risk. HIMS, AppLovin. I'm gonna make a list. Let me know if I was looking at HIMS. Let me know if there's any stocks. I'll make a list. I'm like going back and forth on HIMS. A lot of stocks we do that with, right? And like I was just complaining to my wife this morning. I was like, I could have made $500,000. And she's like, you always say that. And I don't really, if there's a stock I was looking at and I don't buy it, right? And then years later it goes up a lot, I don't really think of that as a loss. In a way, it bothers me because I didn't buy it. But when I actually own a stock, I own Palantir and I sold it at $20. It kills me every day. How do you get over that? It's just so hard. Even if if you lost a few $100s by selling at the wrong time, it's hard. It's hard to just let that go. I guess that's what makes us perfectionists. I don't know. So the first page are the debt instruments and the equity. Most companies should have this on their first page of their quarterly filing. And then here are the chapters of the 10Q. If you want to jump to the income statement, the statement of earnings is the income statement. You could jump to the balance sheet. You could jump to the statement of cash flows. What's up, Bum Spanka? Good to see you. You're in the Netherlands, so it's probably pretty late or really early in the morning. So thanks for joining. So let's see how they did, because it's kind of like a mutual fund, Berkshire Hathaway. It's not like an individual company, because an individual company can go bankrupt. It happens all the time, and it won't bring down the economy generally. I mean, if a really big company like Nvidia goes bankrupt, it will have some effect, but it won't bring the whole economy down. There were really big companies that have gone bankrupt, and of course there's some effect. The people who own the stock, and then it does affect other stocks because some companies sell to other companies. They sell products and that are used in the supply chain of another company. But generally, one company goes bankrupt. After a few months, nobody remembers, and life goes on. But if Berkshire went bankrupt, that means pretty much the U.S. economy would go bankrupt. When I sell options too soon, they go up. I tell myself to find another play. It's so because especially with options, you always look back on options because it's a timing thing, and you can time it perfectly. You can like in a sense, you can say, I know this stock will go down, or I know this stock will go up, and you're correct, and you don't make any money because you're just off like a week or a month. It's painful. You're en route to Dubai. Oh, wow. That's pretty cool. Is it a vacation or work? You're on a plane. You're communicating on a plane. It's pretty cool. So let's go. We'll look at that balance sheet. Their balance sheet, their income statement, statement of comprehensive income, which I don't really talk about too much, but we could talk about that. But they have a lot of stuff in here. That's why I say if there's one report you look at a year, maybe this one, because there's a lot of information in here. And even if you don't understand some of it, every year you learn a little more, one extra thing. A lot of stuff. Okay, let's go back to the income statement. That's probably the most common financial statement, the income statement. CLSK. Okay, thank you for the donation. Really nice. Very CLSK. Clean Spark. And I'll try to do DCF on your suggestions, but obviously, if there's 100 suggestions, I can only pick. So if you do donate, you don't have to, but I'll definitely do it. Okay, so Clean Spark. Not a small company, 2.5 billion market cap. They're still at negative free cash flow, and negative seems to be getting worse. Negative 1.1 billion. Let's just look at the analyst forecast. Get an idea of if the analysts project free cash flow will be positive in the future. Because the analysts, the way they get their forecast is from the company themselves, the company's forecast. So it does appear that they will have positive free cash flow by 2026, positive 262 million. So let's pretend it's nothing in 2025. 262 million. And this is where we kind of use our kind of judgment. So if I was to run a DCF, and I've done this a million times, last half, thank you. Very generous. I appreciate the donations. You don't have to, but it's really nice. It means a lot. So the WACC is kind of like a risk measure. The higher the WACC, the higher the risk. The lower the WACC, the lower the risk. It is based off of how much debt and equity a company has. But generally, if you're a publicly traded company, the WACC is between 8 and 12% in that range. Obviously, in a high interest rate environment, remember 2-3 years ago, WACCs were getting up there, 15%. In a low interest rate environment, WACCs are getting pretty low. But when it's all what's it called? There's a website called Finbox that I use sometimes. It gives you like a range of WACCs. But I've been doing this so long, so I kind of have a sense of where the WACC should be for a particular company. And you should go to earn a side of caution. Using 10% is probably a good idea, even higher. So in a likely scenario, the stock is worth $12.42, based on what the future cash flows will be. It's trading at under $9, so it's trading at a slight discount, not a huge discount. But this is the information we have, right? And that's all you can do at this point. Like no one would have been able to predict there would be a stock worth $3 trillion in the year 2000. I wouldn't have thought it's possible, because I remember when I was younger and growing up, I always thought, what's the first company to hit $1 trillion? And it did happen. I can't remember what year, maybe 2000. Microsoft was the first to hit $1 trillion. But it took so many decades to hit $1 trillion. It took a long time for a company to hit $1 trillion. So I would have thought $2 trillion would take not 100 years, but a good amount of time. Now people are going from 1 to 2 trillion sometimes in a month, which is nuts. And Nvidia did like 2 to 3 trillion in a couple of weeks. Like it just doesn't make sense. So in 2018, just 42 years after it was established, Apple became the first $1 trillion company. So it took Apple 42 years from its start to grow into a $1 trillion company. But the growth now is just on a different level. And Neil, what's up? Good to see you. Yeah, these live streams help me out too, because I learned some new stuff, and I'm kind of forced to look into this stuff. But yeah, throw at it if you have comments. I am kind of going off on a tangent. Well, let me just finish CleanSpark, since I just want to see. Yeah, so it's a Bitcoin miner. It's pretty much correlated to the price of Bitcoin, although it's a company, so it doesn't move perfectly with Bitcoin, but it's highly correlated. So if Bitcoin goes up or down a lot, so will this stock. So if you want exposure into Bitcoin, this is one way to do it. But you also have to look at their business, because they are a business and they have profits, and like any other business. Is there a Wikipedia page for Bitcoin? 1 trillion seconds is 32 years. I like that. Yeah, right? So much, it takes so much time, and the growth is just on a different level. I wouldn't have thought we would grow this quickly, but the reason we're able to grow at the speed we're growing is because the other countries around us. It's kind of like if you live in a neighborhood, if in your area, right? Say your house is $100,000, and that's how much you buy it for. But say all your neighbors went from like farmers. Say you're in a farming town, and now all your neighbors are doctors and lawyers, and their houses are $1 million houses. I mean, it brings up the neighborhood, and it makes your house much more valuable without you even doing anything. That's kind of like how the US is. Like, all these other countries are kind of getting up to speed, especially China. And that's why things are just evolving so much faster. It's kind of interesting when you think about it. But so CleanSpark, I mean, not my cup of tea, but, and let me know in comments about the Berkshire meeting. Is there any information that Warren Buffett said during the meeting that was interesting? Any big, I mean, we go through the financials, but any big sells or buys? Throw it in the comments. Berkshire meeting. I'm listening to it, but sometimes you miss some of these little tidbits. A big mistake. Warren Buffett criticizes Trump tariffs. Okay, yeah, just throw it in the comments. So let's just go through his report. Okay, so the income statement for the first quarter of 2025. So it's almost identical, which is amazing. 9.9 billion. Okay, we're back. So revenue is pretty much identical, first quarter 24 to first quarter 25. And the way he generates revenue, because they don't do any, they don't make any products, they don't provide any services. They're a holding company, and they hold stock in other companies, and those companies they hold stock in are operating businesses. So they don't do anything. It's just a handful of guys who work at the corporation Berkshire Hathaway, but they control a lot. So they have an insurance arm, which I think is what they're known for, their biggest revenue generator. So their insurance section generates 78 billion of revenue. Almost same as last year, which is really interesting how close it is to last year. Insurance premiums is 22 billion. So if you have Geico insurance, car insurance, and they own Geico. So if you get a policy where you pay, I don't know how much rates are where you are, $200 a month for your insurance. You send a check to Geico for $200 every single month, and you don't get anything until something goes wrong. You get into a car accident, you totally your car, and Geico will fix it or send you a check for the repairs. So all the premiums that people paid into their insurance policies is 22 billion. Even more sales and service revenue, 48 billion. There's a lot of cash sitting at insurance companies. They have to invest that cash. They earn float, 5.6 billion. So for just the insurance, 78 billion. Well, insurance and other. Then you have railroad, utility, and energies. That's 12 billion. Freight rail, 5.7 billion, almost identical to last year. Utilities, 5.5 billion. So in that segment, 12 billion of revenue. I guess like company they own Coca-Cola, Apple. I guess they would fall into this section right here, the 47.8 billion sales and service revenues. They don't make it so clear, which is kind of funny. They should COF riot to Salesforce. Investment gains, so they had a loss. And this is a mark-to-market thing. So they hold stock in a lot of companies, and if the stock goes up or down, they have to report that on their income statement before they actually realize the gain or loss. So that's what that is. That's why Buffett says, even if he had a big gain on his income statement, he would say, ignore the income statement, just look at the statement of cash flows. It's influenced by the mark-to-market adjustments. Okay, now you have all the expenses. These are the expenses of the companies they own. Insurance losses, because you were paying Geico a monthly premium. But what if you get into a car accident and Geico has to pay you? These are the funds they paid to their policyholders. Almost 15 billion. So they collected 22 billion. They paid 15 billion. So their profit is about 7 billion for just the insurance. Then you have life, annuity, and health benefits of 1 billion. Cost of sales, that's the main one. I think this is what would include like See's Candy, all those companies they're invested in. 39 billion, those expenses. So total expenses, 78 billion. That's all the expenses. These are the expenses the companies they own report on their income statement. Net earnings attributable to Berkshire, 4.6 billion, which is down from 13 billion. But like Buffett would say, don't worry about this. Just look at the statement of cash flows, because this is highly influenced by a lot of counting. So average A shares outstanding, 1.4 million. Is that so? 1.4 million times 800,000, because each share is 800,000. So that's 1,164,025,785,000. 1.16 trillion. Does that match? Yeah, 1.1 trillion. That's their market cap. Because most of the time when you see shares outstanding, the dollar amounts are in like thousands or millions. These are actual shares. So they only issued 1.4 million shares for the entire company. So these 1.4 million shares, some of those were cut up into pieces of 1,500 and sold as B shares. And a statement of comprehensive income is kind of in addition to the income statement. You see that 4672, which is the end of the income statement, 4672. And then other comprehensive income, which are these things. Things in other comprehensive income are like changes in derivative contracts or pension plans. It's not a common report that people look at. Foreign currency translation, and they do break down everything that's in it, but most people don't look at this report. But it does affect the company. These are unrealized gains or losses that could, if you see a really big, this is an unrealized gain of 500 million. But if it's a big unrealized loss, that could have some future problems. But it's usually insignificant. Statement of cash flows. So that's why he said, look at the statement of cash flows. It's a better indicator than the income statement. So you could see the income statement for the first quarter. It showed net income of 13 billion. This year, 4.7 billion. But a statement of cash flows is similar, right? Because the statement of cash flows kind of adjusts the income statement. You add back or minus out the non-cash items, and you come up with the actual cash that went through the business. So that's why it kind of smooths things out. It removes all the accounting stuff. Investing section, I think most people who look at the statement of cash flows look at the operating section. But investing section, that has to do with investments in capital expenditures or sales of CapEx. Sometimes you sell machinery and equipment. It also has to do with investments. When you invest in short-term securities, which they do a lot of, $158 billion they sold in T-bills. That's a big company. 158 billion. But that's just what they sold in T-bills for the quarter. They purchased 138 billion of T-bills. Also in the investing section, if they acquire another company, you'll find acquire another company for cash or sell another company for cash. If it's a non-cash acquisition, it won't show up here, but if anything cash related shows up in here. And then the financing section, if a company pays a dividend, which they've never done, it shows up here. Or if a company adds debt or equity, it shows up here. Or if they buy back debt or equity, they pay down debt, which they pay down 1.3 billion of debt, repayment of borrowings of insurance and other businesses. They added 2.4 billion of debt. These borrowings of railroad, utilities, and energy businesses. And then They also have changes in short-term borrowings net. Now you would think that would be in here. But it depends what your what the debt is for. The debt here is just is for the is when you invest cash, extra cash, so you can earn a little interest on your cash. It's kind of like if you have, say you have like $50,000 in your checking account and you don't need that much cash. You in your mind you're like, I only need 10,000, that's my comfort level. You take 40,000 and put into a money market fund just to earn 2 or 3% interest because you don't need the money right now, but you just want to earn something on it. That's what's up here. But when you use debt for acquisition purposes, or use debt for it just depends what you use debt for. But I don't know if they would explain this, but I would be interested to see how they explain it. No, they don't. They're not going to have it. But yeah, let me know in the comments. Is there something like Buffett said? Anything in particular about his investments? Anything in the first quarter? Here they show the they use equity method accounting for Kraft, Heinz, and Occidental Petroleum, also Berkadia. So if you own, generally, if you own above 10% of another company, you have to use equity method accounting. I think the term is if you have significant influence on another company, then equity method accounting should be used to report that company's gains or losses. So this shows up directly on their income statement. If you don't have above 10%, if you own like 1% of another company, then you report their gains or losses on your statement of cash flows. 126. Let me see if that number, this is page 11. It is right here, 126. So equity method earnings, they had a gain of 126 million. And if you want to know what the 126 million represents, this is what Buffett does when he reads through these reports. He kind of picks apart the number to understand it. That 126 million is a gain of 195 million from Kraft, a loss of 82 million from Occidental. This is directly from their income statement. Kraft Heinz first quarter. Let's see. So they had showed a gain of 712 million for the first quarter. They're 195 million because they don't own 100% of Kraft. They own whatever it is, 12%. So they multiply their ownership by what the net income was, and that's how they come up with 195 million. Occidental had a loss of 82 million. So if you look at Occidental, they had a net loss of 295 million. So they take Occidental's actual loss times the percentage of ownership, and that's how they got 82 million. Berkadia had a gain of 13 million. What do you think about SoundHound? Seeing if there's anything interesting we could talk about. Did they mention how much Apple they own? The 5 largest holdings at each date were Amex, Apple, B of A, Coca-Cola, and Chevron. Our investment equity securities over the years has been concentrated in relatively few companies. The fair value of 5 of the largest holdings. He picked up a lot of Occidental, and he earns 8% on that. He bought preferred stock. So that's like a guaranteed return. And the company hasn't been doing that well. The stock price. Usually it goes up a lot when he buys it. They've really struggled. But he owns preferred shares. Preferred shares are higher in a capital structure. So in the event of default, preferred gets paid before common. But I guess this is kind of like dry or a little boring, some of the stuff. Soundhound. MKL. I think it's interesting, but I could see why some people think it's a little boring. So here's a GDP. Germany is third. Let's put a number. Let's see a cumulative. Cumulative. So China and the US is 44% of the GDP. So just 19 countries make up 80% of the world GDP. In 19 countries, there's only like 10% of the world. What is 190 countries in the world? This says 209. I don't know how accurate that is, but 9%. Some GDPs just are not listed. He still has a huge stockpile of cash. So cash and short-term investments, 37 billion of cash and 305 billion of T-bills. So 342 billion. Sheesh. $342 billion So he has just in cash, which is funds that are left over, not his investments. Like his portfolio is obviously worth more than 342 billion, but just in cash, he has more cash in over 100 countries GDP. And on a cumulative basis, he has more cash than the bottom 64 countries. And some of these countries are, have tens of millions of people in it. And he's just one entity. But don't people always like, they use this as ammunition to say how unfair and unjust the world is. Why does one person control so much wealth? I mean, I guess if one person controlled a lot of wealth and was doing harm, like killing people, that's one thing. But he's most people who accumulate a lot of wealth do good things, like provide a product or service people want, or even better is give jobs to thousands or millions of people. People who complain usually don't ever supply a job in their life. They just take. When you build a company, even if it's a really profitable company, the more profitable the company is, the greater chance of people hating you. That's just how it is. And you supply millions of jobs, you're doing a pretty good thing. So SoundHound, that's a pretty popular stock. $939, 3.7 billion market cap. Let's take a look at so does anybody use SoundHound? I do use it with one of the companies I work at. It develops voice AI solutions that enable businesses across automotive, TV, Internet of Things, and customer service industries to deliver high quality conversational experiences to their customers. Sometimes I'm talking to an AI and I don't even realize it. Like everything seems normal. I mean, it could be a little annoying if it's a really nuanced question. Like you can't say to AI, what's a good investment? It's not going to give you a good investment and you'll be rich. You have to do a little more digging. But if you want to say, what's the capital of North Dakota? Yes, that's a good thing for AI to give you. And it's much better than that. Like it's gotten pretty advanced. So let's look at the future growth. Let's look at their free cash flow. So they don't, in the there's no free cash flow growth in the future. Let's see if we can estimate their revenue. So our revenue is 200 million. Equals 0.2. The way I like to look at it is a company can convert 10% of their revenue. It's hard to do it with this thing right here. Let me just delete that. $200 million. Let's see if they grow 50% over the next 2 years. We'll assume negative free cash or no free cash flow in the next 2 years. And let's say 3 years from now, they convert 10% of their revenue to free cash flow. Okay. 450 million. So if they convert 450 million. Okay, so I'm at $13 for this one. It's a little tough when a company has negative free cash flow, so you have to do a little bit of estimation. Was checking out your dividends mining stream. Would be interested to hear VAR Energy, VARRY. VARRY. Let's see. Okay, this is it's trading OTC, so it's 578. Is this a new stock? It started trading? Oh no. $3.12. So it's come up a lot the past year. Market cap 6.1 billion. I have a feeling, let's see if they have positive free cash flow. They do have positive free cash flow. The forecast is 1.3 billion by 2027. Well, we're not doing a DCF. I forgot. This is just the dividend thing. So 945 million net income. $619 million. Let's see. No buybacks. It looks like they're pretty consistent with the dividend payment, at least the past 3 years. The last dividend was from February 2025. Before that, October 2024, August 2024. So they're pretty much at 12 cents. Each quarter. So that's a yield of 8.3%. This says 16%. Why is it so different? 12 cents. $6.8 billion. 578. I wonder why it's so off. Maybe it's the foreign currency. I mean, it shouldn't be much different. Maybe 30% the most. I have the same shares outstanding. But this I think, yeah, I don't know what country is VAR Energy. It's in Norway. So that's a euro. So it should be, euro is almost identical. They pay 2 dividends. Okay. Because the way this site makes it look, it makes it look like they pay quarterly. because it was February. Okay, well that would make it even less, actually. Well, if I just use the numbers in the model in the on this website, this is a 50-50. It's a coin flip. There's no either way. There's no like it's not a buy or a sell. It's kind of like a midway one. When you do invest in foreign companies, sometimes you do get hit with an extra tax. Something to consider. It's a pretty new company, 2018, Norwegian oil and gas company. Company was established in 2018 by the merger of Eni, which is one of the majors, one of the biggest oil and gas companies in the world. It's a super major oil company. Var Energy is a public traded listed in Oslo, with Eni as the largest stockholder. Let's see the ownership. Yeah, Eni owns 63% of the company. So Eni's a great company, been around a long time. That would definitely give me comfort having them as a backstop. $40 billion market cap company. It's ran by the Italian government, which isn't the most honest government. So I understand. They own 30% of the company. They're not always on top of reporting their taxes. Italian citizens. So I wonder if that is a reason the yield is so high. 16% yield. Yeah, I don't think you're getting a 16% yield though. I think it's closer to 8%. And then if that additional tax, the foreign tax, you're probably down to like 6%. With a lot of risk. The stock is up. It's up 85% in the past year. So it's doing pretty well. Let's see how the stock is performing. So in 2023, it started out at 6. It did get up. It's pretty tight, between 5 and 7. So it's a really tight range actually. They're guiding for a second dividend. Are you Norwegian? Your name looks not American, because in America we don't have K and V next to each other. Norway is a good country to invest in. I think they have a pretty solid economy. Any other updates from a Berkshire meeting? I'm sure by tomorrow, because when did a sound bite like a big thing? Like when he sold all that Apple the past few quarters, that was a huge sound bite. So if anything like that, you'll hear over and over. I'm just trying to get ahead of the game. Berkshire meeting. So obviously he's going to talk about tariffs. He talked a lot about being American, how lucky we are to be born in America. Buffett defends trade amid tariff pressures as Berkshire cash sets record. Let's see what this article says. Buffett says balanced trade good for the world. He downplays the concern about all the cash. Operating profit down 14%. Insurance in California has been really, really difficult. Lots of people in California are locked out of insurance. Some companies won't insure. If you're in California, they just won't insure you due to wildfires. You have to go directly to the government. There's like a plan in place with the government to get insurance. Buffett offered a defense saying tariffs should not be a weapon and the U.S. would be better if other countries shared its prosperity. Buffett spoke at Saturday's annual meeting. Balanced trade is good for the world and not a weapon. I don't think it's a good idea to design a world where a few countries won. I don't think that the more prosperous the rest of the world becomes. $348 billion of cash. What did I say in my the reason I'm a little lower, I didn't add this 5288. This is on his balance sheet. 347.7 billion. Is that what he says? Yeah, exactly. Look at that. Okay, so that's on his balance sheet. It's good. It's good for you guys to check these things. Because I'm not saying most of the time you're going to be wrong. Because a lot of times people say, "Oh, Yahoo Finance dividend says this." They don't know what they're doing. Oftentimes they're right. It's just we don't know what we're doing. So this is a good way for you to understand his balance sheet better, because I initially just added these two numbers to come up with his cash. And I did see this number when I did it, but I kind of just ignored it because I knew it was like a rounding thing. But it's good to you learn better when you start fixing mistakes. So 347.7 billion. Berkshire cash pile. I just wanted to put it into my Excel so I could reference it in the future. So it's up about 13 billion from last quarter. They keep talking about this cash pile. I think they really started talking about it at 188 billion. And now it's nearly doubled from that. But he's an insurance company. Insurance companies have a lot of cash. That's the main thing with insurance companies, is especially life insurance, because life insurance is so lopsided. Car insurance is not nearly that lopsided because you pay monthly premiums, and then when you get into an accident, you claim against the insurance. Life insurance, even if someone dies prematurely, it could take decades to happen. It's usually people get life insurance when they're younger, 20s, 30s, and then if they ever need it, oftentimes they won't need it. if they ever need it, it's still going to be like 30 years. So you have so much money just sitting with these insurance companies. That's the name of the game. That's why he's always has a lot of cash. I'm from Sweden. Norway has a withholding tax on dividends. He urged patience to investors worried about the direction of the U.S. economy and the country itself, saying they should consider their approach to investing if sudden market declines. People have emotions. You'd have to check. He nonetheless retained his long-term optimism for the country, saying criticism of politics. It is a lot of cash, but you have to look at things on a percentage basis, not a dollar basis. But even as a percentage basis, it's still a pretty good chunk. It's kind of like 348 billion of cash. It's kind of like if you had $100,000 portfolio and you were like and you had 70,000 invested in stocks, 30,000 in cash. I'm assuming this is your brokerage account. Like you have a checking account with say 10,000 in there for everyday needs. But if this was your brokerage account and you always had 30,000 in cash, I would say, how come you don't invest that? Like it always seems to be sitting there, and your stocks are doing well. And then you just say, I don't know, just waiting for the right time. So it's a lot on a percentage basis and a nominal basis, but you have to trust he knows what he's doing. It's cash stake where insurance loss from wildfires contributes to 14% decline in operating profit. So that was a decline in operating profit, the January wildfires in Southern California. Lots of IBSBF. Investor AB. Oh, is that like a type of pension or mutual fund that's ran by the government? $91 billion, big company. Investor AB. Okay, so it's a private equity firm, because a lot of times with these big investment arms, it's the government that controls it. Is that the biggest shareholder of the government? It's yeah. The biggest shareholder is AMF Founder AB. Interesting. Yeah, no, where's the article we're looking at? Okay. The insurance business, including Geico, had a very strong year in 2024. He said it will not be replicated in 2025. Prices are down this year, risks are up. Net income fell 64% to 4.6 billion. There was a big unrealized loss on Apple. His cash stake grew from 334 billion. The company repurchased no stock for a third quarter and was a net seller of stocks. So you would think he has a lot of cash. Why doesn't he buy back his own stock? Well, his when his stock price is high, he's less likely to buy shares. Just like when you buy stock, if it's trading on its all-time high, you're less likely to buy that stock than if it was trading at a 52-week low. Or at least that's how you should be. He downplayed concern about Berkshire's cash, saying company came close to spending $10 billion recently. We're running a business which is very, very opportunistic. We have made a lot of money by not being fully invested at all times. So they're big on the Japanese companies, Japanese trading houses, Mitsui, Sumitomo, Mitsubishi. Berkshire share prices, they're doing this. He's up 19% year to date. The S&P is down 3.3%. For many, Berkshire's diverse portfolio of businesses offers a mirror into the broader U.S. economy, which shrank for the first time in 3 years. Yeah, it's really doing so much better than S&P 500. Because on the same day, or maybe the same month, I redid my retirement account, and I put I bought. Well, actually, this is a combination of my retirement and brokerage, but I bought Berkshire the same time I bought S&P 500, and you can see the S&P 500 is up 85%, Berkshire is up 208%. So it's turned out to be a good investment. And this was in 2017. I invested in Berkshire and S&P and also Meta in 2017. And for 3-4 years, the S&P was beating Berkshire. So I was annoyed. I put so much into Berkshire, and it wasn't even beating the S&P 500. But now it's rebounded since then. Yeah, I do think it will outperform, because it's kind of like you have the greatest money managers, and they've proven they know what they're doing. The market is not perfectly efficient, but it is pretty good. So in putting your money in the S&P 500, it's a good bet. But there are people who are smarter who've done better, and that's why I'm putting my money into them, because it seems like they do it better. I can't perform better than them. Most of my stocks aren't up as much as Berkshire. I think Netflix is the only one that's beating Berkshire. But in a short term, some of my stocks kill Berkshire. Like sometimes I invest in a stock, I'm up 300-400%, and then after a few years, I'm up 50%. But we got to put our money somewhere. Some people use it for their own personal businesses or buy a house. So it's just I have it in different places, depending on obviously how much money you have. But okay, I'm gonna talk about cap rates. Actually, maybe I'll talk about the 1031 exchange in case anybody wants to talk about it here. So I wanted to prove mathematically that doing a 1031 is better than not. So I'm going to give you an apples to apples example on how a 1031 exchange works. So a 1031 exchange is a way to defer income taxes on real estate investments. So if you're a real estate investor, you're really familiar with 1031s. So I'll show you. And let me know in the comments if it's clear or not. So I'm going to do 2 examples. So this is example 1. This is example 2. So this is using a 1031. This is going to be no 1031. So here. So say you your first investment, your first real estate investment, you can't really use this for your personal residence. It's for investments. Say you buy a piece of real estate, maybe a little apartment building with 2 apartments in it for $100,000. This could have been back in 1990. And it doesn't matter how long it takes. It could take 2-3 years or 20-30 years. But let's just say you sell it after a number of years, 5 or 6 years, and it triples in price. So you bought it for 100, you sold it for 300. You had a gain of $200,000. So anytime you realize a gain on an investment, you have to pay tax on it. So long-term capital gains is 20%. So you have to give the IRS $40,000 in taxes for this particular investment. One way around it is you could defer the taxes to the future. So you don't pay any taxes today. But the only way to do that is you have to take that $300,000 and roll it into another property within 6 months. So say you find another apartment building for $300,000. That's how much it's selling for. So you take the $300,000 and you put into investment number 2. 1031 saves your capital. Yeah, that's what I'm showing you mathematically. Sometimes it's hard to really understand it, just trying to think, how does it even save taxes? Because you do have to pay the taxes. It's not like you don't pay it. If you die, I guess, then your heirs get the stepped up cost basis. So that's even better. But let's just assume you don't die. So you have to do a 1031. You have to file a 1031 with the IRS. That's the name of the form, the tax code 1031. And then you buy a second property for $300,000. So you can roll all the money into the second property. And let's just say after 8 years of managing that building, it doubles. And you sell it for $600,000. The gain is $300,000 on this second investment. And remember, when you profit on an investment, you have to pay taxes. So 20% of $300,000, because you only pay taxes on the gain, is $60,000 in taxes. But you elect to do a 1031 exchange. So you're allowed to roll that $600,000 into another property, and you defer that tax payment. So the $600,000, you find property 3, and then you run that for, say, a decade or however long you want, and you sell it for double. Now you have a gain of $600,000 on this third property. So the taxes you have to pay on the third property is $120,000. Since you're retiring, you're not going to do any more exchanges. So you have to pay all the taxes you deferred in the past. So the IRS expects a check for $220 because you have to pay the $40 from investment 1, the $60 from investment 2, and now the $120 from investment 3. So you send a check to the IRS for $220,000, and you have $980,000 in cash left over. How does it come to 980? Well, you sold the last building for $1.2 million minus the $220,000 you sent to the IRS. So that's leftover cash. Now let's exactly the same example. You start with $100,000. So let's say you start with $100,000, like you did investment 1. You say it triples in price, just like the first example, triples in price, and you sell it for $300,000. You have a gain of $200,000 from that first investment, and you pay the taxes right away. So you pay $40,000 to the government. What's left over? $260, because you sold it for $300. You paid $40,000, so that's what's left over after this particular investment. $260. So you take the $260 and you buy a second property. And let's just say it doubles in price, just like in the first example, it doubled, investment number 2. So it goes from $260 to $520. The gain is $260 on the second investment. You pay 20% taxes on the $260. So right away you pay the IRS the $52,000. You do not defer it. No 1031. And what's left over after investment number 2? $520. That's what you sold it for, minus $52,000 of taxes. So $468 is left over. Now you take the $468. You buy a third property, and that doubles, just like the first example. The third property doubles in price. So you sell for $936. The gain is $468, which is $936 minus $468, and you have to pay taxes on gains. 20% is the rate you're paying. So 20% of $468 is $93,600. You send that to the IRS. So in example 2, you paid $185,600 of taxes. So you actually paid less taxes, $34,000 less to the IRS. But how much cash do you have left over after investment 3? $842,000. Because you sold the last property for $936 minus the check you sent to the IRS for $93,600. So $842,400. So if you do a 1031, you would have 16% more cash left over from the same $100,000 investment. So that just shows you how deferring your taxes, it's kind of like using leverage. So that money you would have paid in taxes in the past, you rolled it over into another property. And there's similarities with stocks too. If you have an IRA or a 401k and you put it into an account that's shielded from taxes, you can buy and sell stock as much as you want. You never pay taxes until you take the money out at the very end. I used to think, I was so stupid. I used to think it didn't matter if you put it into a brokerage or retirement. Taxes didn't make any difference because either you pay taxes now or later. But I didn't think about the growth. You could have grew your money with it. Instead of paying the taxes, you could have used that money and grew it. So the rules for the 1031 is it has to be a U.S. property. It's generally an investment property and not personal property. You have to do it within 180 days of the sale. So if you sell one property, you can't take a year to buy the second property. And you might pay taxes on some, it's unlikely you're going to find exactly the same, a property for the exact same amount of money that you paid. It might be more. So then you don't have to pay taxes, but it could be less. And there could be other things, like if you have a mortgage on one property and a mortgage on another property, you may have to pay taxes on the difference of the mortgage. And the nice thing about this is you pay long-term capital gains rate, not ordinary income tax, because ordinary income tax could be like 35, 36, maybe even close to 38%. Long-term capital gains is generally lower, could be as low as 0, which would be nice. Imagine you buy a property for $200,000, sell it for $220,000, you don't pay any taxes because a $20,000 gain. Obviously, you have to combine the gain with your income. If you're still under the limit, you get a big tax break. So yeah, so I hope that is interesting. And this is part of investing in REITs. This is how REITs benefit from stuff like this. And I might do a video on cap rates. So I'm going to probably head off. I'm getting a little hungry. Yeah, thanks for joining, and I'll try to do another stream later or tomorrow. Talk to you later. Thanks.